Now, you've all heard the stories about Bitcoin, millionaires or billionaires, NFTs, tokenized real estate, tokenized artwork, and the like, all with digital currency. But I would urge you to be extremely careful who you're dealing with in digital currency transactions. And if you're selling some of your digital currency, peer-to-peer transaction, say someone overseas that you're not aware of, you don't know, you need to do two things. You need to do thorough due diligence and background. And this is something we help our clients with all the time. What I'd recommend is you get what I call a client information sheet or a CIS sheet from anyone you're going to do business with. And in that, you need their full names and contact information, their company names, their passport number and a copy of their passport, dates of birth, and if relevant, if they're U.S. citizens, you want to get a social security number. With that information, we can do a pretty robust background check and we can tell you if there's any likelihood of a problem with that particular party. So you need to be very careful about those type of transactions. Do your due diligence very thoroughly. Also, most of the time, like any other deal out there, if it's too good to be true, if it sounds just fantastic and it seems too good to be true, trust me, it is. It's fraud. And run, don't walk away from that deal. Hello, and thanks for joining me again. Paul Goyette here from the law firm of Goyette, Ruano, and Thompson, and I appreciate you coming back and joining us. Today, what I'm going to talk about is digital currency, specifically cryptocurrency, and the legal minefield that surrounds cryptocurrency. But before I get into it in more detail, a couple of things. First of all, do me a huge favor and hit the like button down there and subscribe to our channel. That'll really help me out. Keep bringing quality content out to you all. So if you could do that for me, I would greatly appreciate it. But what I really want to talk about is what are the legal pitfalls and risks that surround cryptocurrency ownership. Now, many people have just bought cryptocurrency as an investment, watching it go up in value many times over the years. I first bought Bitcoin back in 2007. And since 2007, the value of the Bitcoin I bought, 30x more in that period of time. It's gone way up. It's had wild fluctuations in value, but most cryptocurrencies do, and it can be very, very unstable. But most people have bought cryptocurrency as an investment and a store of value, hoping to make money off it in the long term. But there's numerous legal risks that you need to be aware of, and our law firm helps people with these very frequently. One of the risks is your wallet is going to have a very detailed key or password that you need to keep track of. And then the other big area that we help our clients on is with estate planning, where we get them to include their digital currency holdings, just like all their other assets, into their trust and their estate plan so they can be dealt with as time goes on. Now, sometimes we've had clients who elect to sell their digital currency or trade it as they become more elderly and they don't want to pass that along to their heirs necessarily. But certainly you can pass along your digital currency to your heirs just like any other asset, just like your real estate, just like your money, just like any other assets. But it needs to be taken into account. And just like any other asset, if it's not included in your estate plan, it's going to fall through the cracks. At the very least, it's going to have to go through a probate. But a bigger problem is you may not ever be able to access that digital currency wallet. Another legal risk we run into all the time is smart contracts. Now, smart contracts are based on the blockchain. They're an ingenious form of contracting where Jeff and I can enter into a transaction. We're going to sell Jeff Bitcoin. That's going to be a blockchain secured transaction. And in that, we will have a smart contract that lays out the details of our particular transactions, such as how much Bitcoin will be involved in the transaction, the pricing, the transfer dates, procedure, and so forth. Smart contracts, just like old school legal contracts on written paper, are legally binding contracts. The thing with smart contracts, they are immediately enforceable on the blockchain. You don't need to get lawyers involved. You certainly don't need to get judges in the antiquated court system that we currently have to endure. They are immediately enforceable, but you need to know what you're getting involved in. So we help clients fully understand the smart contracts they're entering into and what all of the implications are. Now, another risk that our clients face are hacks from exchanges. Now, you hear from time to time in the news about Bitcoin or digital currency hacks where large amounts are stolen. Well, those are not typically stolen from any individual wallet. Those are very, very secure, but where they tend to be stolen is during transactions, where they're gone through an exchange. So if I own Bitcoin, for example, and I want to cash it out into US dollars, or I want to convert it to another digital currency, I would do that through an exchange. And there's a number of exchanges out there, Coinbase being one of them. Those can get hacked. One word of warning, this area of digital currency trading is full of fraudsters all over the world. So you have to be extraordinarily careful who you do business with and how you do business with. And then finally, the biggest risk our clients face are the tax consequences of owning cryptocurrency, because they can often sneak up on you and they can be a major wallop if you're not careful. Now, first, let me be clear. Merely owning cryptocurrency and having its value hopefully appreciate, hopefully significantly, or even depreciate, doesn't have a tax consequence. It only has a tax consequence when you cash out that digital currency or you sell it for another digital currency. That's when there's going to be a significant capital gains consequence, assuming the value went up and you made money. So you need to be aware of that before you cash out your digital currency, before you trade it or sell it. There's going to be a tax consequence for that for sure. And that'll be a capital gains tax consequence. And that can vary from state to state. Some states have very low capital gains consequences. Other states have relatively high ones, like California, which is the taxation capital of the world, has a relatively high capital gains tax rate. And of course, there is a federal capital gains tax rate that you will have to contend with. Another tax consequence that comes up is if you are doing staking. And staking of cryptocurrency or digital currency means where you're receiving ongoing revenue. You can look at it like dividends, possibly, from your digital currency activity. That is a taxable event. So you need to be aware of that as well. That could hit you on the income tax level. And you need to be aware of that because that's a much higher tax rate. The last thing I'm going to talk about is you've probably heard about Central Bank Digital Currencies, CBDC. And those are digital currencies issued by various governments. Now, a number of governments around the world have already issued a central bank digital currency, including Russia and China, where they take, say, Russia, for example, what they've done is they've issued a digital currency based on the ruble, and other countries have done the same thing. The United States has made some noise about issuing a central bank digital currency on the US dollar. The thinking behind it being that their digital currency would replace actual hard money. Remember, blockchain transactions are highly transparent. So if you're using a central bank digital currency, that government, any government that's involved in those transactions, will be able to see exactly what you're trading in. So for example, at some point in the future, you might be able to go out and buy pizza and beer and ice cream with your central bank digital currency. But then of course the government will know about it. And of course, then what they're going to do is send you unsolicited information about how to avoid type 2 diabetes or anything else in your life. I personally do not want that kind of government intrusion in my life. What I do see the future of being very robust is Bitcoin and other prominent cryptocurrencies on the blockchain for a wider and wider range of transactions. So I think in the future, you're going to be able to do a lot more transactions with digital currency. You'll be able to trade digital currency on your phone to go grocery shopping, to buy gas at the gas station, to buy ice cream at the ice cream shop, to open up a bar tab at your local bar. I believe you're going to be able to do that. But with that comes a number of legal challenges and hurdles that you have to be aware of. And remember, anything that's done on the blockchain is highly transparent and highly verifiable. So if you're trying to do some sneaky transaction, it isn't going to work. It's going to be highly visible. So I hope that helps gain some very elemental and beginning understanding of blockchain technology, cryptocurrency that's built on the blockchain, and some of the legal challenges you might face. We're happy to help you with this. Again, please hit the like button. Please subscribe to our channel. And if we can be of any assistance to you, please, by all means, get in touch with me and let me know how I can help you. Thank you.